The man at the table. I remember the first time I sat across from him. It was a quiet Thursday morning, the kind of morning when the noise of the world hadn't yet caught up to your thoughts. I was clutching my notepad, pages half filled with scrawled notes, bond yield curves, and acronyms I was only beginning to understand. He looked nothing like I expected, no suit, no expensive watch, just a well-worn sweater and eyes that carried decades of market wisdom. He sipped his black coffee slowly before speaking. "So," he began, "you've been watching the numbers. But have you listened to the story they're trying to tell?" I was puzzled, and he smiled at my silence. "That's the problem with most investors," he continued. "They watch the markets like engineers watch gauges. But money moves like water, flows. And when it changes direction, it tells you more than any earnings report ever could." That was the beginning. The day I stopped chasing numbers and started listening for the story of capital. Part 1. The repricing of trust. The expert I met that day didn't lecture me about markets. He told me stories. Stories of the past, of inflection points, of quiet warnings buried in the noise. And the story he told me that morning began with rising bond yields. You see the 10-year U.S. Treasury yield at 4.8% and think it means the economy's strong? That's what most people think. But that's not what the yield is saying. He pulled out a folder of charts. Line graphs stretching back to the early 2000s. Colored zones marking recessions, peaks, and rate decisions. The historical echoes. Back in the early 2000s, he said, yields rose because the economy was expanding. The Fed hiked rates to cool inflation. Investors demanded more for lending their money longer. Makes sense, right? He nodded. But what if yields rise and the economy isn't growing? What if GDP is crawling at 1.2%, inflation's cooling off, and yet yields keep climbing? That was exactly what the data showed for mid-2024. Then it's not about growth anymore. It's about trust. He spoke the word like it carried weight. And in the world of money it does. He showed me a graph, foreign holdings of U.S. Treasuries. China and Japan, two of the largest holders, are pulling back. 8%, 5% drops. Quiet withdrawals. They're not dumping treasuries that would make noise. They're slipping away. And the U.S. debt. It had passed $33 trillion. The expert tapped his pen on the chart. Do you think that number makes people feel safe? The trust repricing theory. Here's what's really happening, he said, drawing a simple equation on the napkin. Higher yield equals higher risk premium equals less trust. Investors aren't demanding more yield because they expect roaring growth. They want compensation. For dysfunction. For uncertainty. For the chance that the debt ceiling debate in Congress turns ugly. Again. It reminded him of 2011. I watched as he flipped to a timeline of the debt ceiling crisis. Back then, too, yields rose even when the economy wasn't overheating. And guess what? It wasn't inflation, it was political risk. Leaned back. The bond market wasn't just reacting to macroeconomic signals. It was pricing in doubt. And for those who listened, it was the first whisper of a larger shift. Part 2, 3 strategies carving through the chaos. I asked him how smart money was reacting. He didn't answer directly. He handed me 3 envelopes. Each one is a path. None are perfect, but together they form a map. I opened the first. 1. The discipline of liquidity. Capital is scared, he explained. Scared of duration. Scared of the unexpected. He showed me a chart of long-dated treasury prices. down 15% in a single year. Red ink across portfolios. See, long bonds are like trusting someone with your money for 30 years. But what if that person's starting to look a bit unreliable? That's why institutional investors were moving into short to intermediate bonds, 2 to 5 years. Less risk, easier to exit. Even cash was back in fashion. Money market funds rose by 12% in just one quarter, he noted. Sometimes cash is a position. Liquidity wasn't just safety. It was optionality. The less locked in you are, the faster you can pivot. And in this environment, agility is survival. 2. Credit quality over nominal yield. Don't chase the shiny 5% yield, he warned. Ask who's behind it. He pointed to corporate bond spreads. They were widening. Junk bonds, the riskier kind, were being shunned. Smart money was climbing the credit ladder. Investment grade. Government bonds from nations with budget surpluses. Not the loud yields. The quiet, reliable ones. He showed me data from Switzerland, Singapore, countries whose bonds were suddenly in high demand. People are paying a premium for certainty, for sustainability, for cash flow that doesn't vanish in a downturn. He circled a figure. A 20% rise in institutional investments into green infrastructure. Regulated returns, he said. Not sexy. But in a storm, stable cash flow is king. 3. The flight to alternative havens. The third envelope contained a world map. Dotted lines marked capital flows shifting away from the US. The dollar's dominance is eroding, he whispered. Slowly, but undeniably. He showed me how central banks had increased their gold reserves by 450 tons since 2020, a silent vote against fiat dependence. He spoke of private equity movements into Asia, strategic infrastructure deals in the Gulf, emerging markets with current account surpluses. Korea, Malaysia. They're the new quiet fortresses. And then he paused. This isn't panic. It's repositioning. The smartest players in the room aren't shouting. They're moving. Quietly. Patiently. Part 3. Memory in the markets. The next time we met, he brought a stack of old newspapers, faded and creased, their headlines screaming of past crises. He dropped them on the table, and as the papers spread, they formed a strange mosaic. 2008, 2011, 2020. Markets remember, he said. Even if most investors forget. I asked him what he meant, and he smiled. Technical signals, yield curves, swap spreads, these are not just numbers. They are echoes of past shocks. He flipped to a chart showing repo market rates, spiking unexpectedly in early 2024. See this, he said, tapping the spike. That's a warning. Started here too. Liquidity vanished from overnight lending. Repo markets. The first crack. Back then, he said, banks stopped trusting each other. They stopped lending overnight. And what happened next? Lehman. AG. A cascade. Today's repo spikes weren't as dramatic. But they hinted at stress, not a crash, but discomfort in the pipes of the financial system. And discomfort is contagious, he said. The more fragile the plumbing, the more careful the water must flow. He turned to swap spreads next. Swap spreads. Signals in the spread. Swap spreads are like a whisper between banks, he said. A spread that widens means the banks are saying, I don't trust you. In late 2024, those spreads were stretching wider. Not dangerously but undeniably. Another signal. And when that whisper gets louder, he said, That's when you start watching FX hedging costs. He showed me dollar hedging premiums in Europe and Asia. The cost to hedge USD exposure was climbing. Consistently. Investors want out of the dollar, he explained. But they don't want the volatility, so they hedge. And the price of that hedge. That's the real fear premium. When the flows start tilting away from a currency, that's not just a macro shift. That's the market voting on stability. These weren't crash signals. They were breadcrumbs. And the smartest players, the ones he followed, were collecting them. Part 4. A strategic framework for a shifting world. The last time I saw him, he brought no folders. No charts. Just a napkin and a pencil. You've seen the data, he said. Now let's make a map. He sketched 3 time horizons. Short-term, medium-term, long-term. Below each, he began filling in strategies. Not predictions, positions. You don't fight volatility, he said. You surf it. You position for possibility. Short-term, 6 to 12 months liquidity, flexibility, safety. A short-duration bonds. 2 to 3 years with low sensitivity to rate changes. A money market funds. High yield, high liquidity. A gold and tips. Treasury inflation-protected securities. To hedge against inflation and volatility. A minimal credit exposure to avoid junk bonds. Avoid over-leveraged corporates. This phase is about resilience, he said. Cash isn't lazy anymore. It's tactical. Medium-term, 1 to 3 years rotation and reallocation. Commodities, especially industrial metals and agri-commodities in high-demand cycles. Emerging markets, with strong fiscal discipline and current account surpluses. A green infrastructure and regulated returns. Stable, inflation-linked cash flows. A strategic equities. Not growth stocks but cash flow positive, dividend-paying sectors. Here you're leaning into real assets, he said. You want what the Fed can't print. Long-term, 3+ years diversification beyond the known. A private assets. Infrastructure, logistics, and essential services. A DeFi and decentralized finance infrastructure. Cautiously but with vision. A multi-currency exposure. CHF, SGD, gold, and selected emerging market currencies. A family office strategies. Global diversification with capital preservation mandates. The long game isn't about doubling your money, he said. It's about not losing it when the tide shifts. And above all, trust recalibration. Trust is the currency. Everything else, yields, spreads, growth, follows it. Part 5. The ending is not the end. When I stood to leave, he stopped me. One last thing, he said. Remember, capital doesn't vanish. Migrate. The question is, will you be where it's going or where it's leaving? I nodded, but I didn't fully understand. It wasn't until months later, watching headlines about bond downgrades, regional bank liquidity crunches, and yet another round of global capital reallocation, that it clicked. The yields weren't just signals. They were stories. And every investor, knowingly or not, is a character in them. I write this now, not as a beginner, but as a participant, one who has stepped into the stream of capital and chosen to listen. To watch not just the numbers but the movements behind them. If you're reading this, maybe you felt it too, that quiet pull beneath the market noise. The reshuffling of trust. The revaluation of risk. So I ask you, where do you see capital flowing? What do you believe about the next cycle of trust? And how are you positioning for the story yet to unfold? If this journey resonates with you, if you see value in maps drawn on napkins, in stories told over coffee, in whispers of yield curves and memories of past crises, then I invite you to stay with us on Richness Journey. Because in the end, the richest insights are not found in numbers, but in the flow of capital. Please leave your comments below, and if you find value in this exploration, subscribe to Richness Journey, where we strive to understand the movement of money beyond mere numbers.